I let the gold-silver ratio determine what I buy. And at 100 to 1 right now, it might go higher. And there are people saying that it's going to be this way permanently. The second that gold goes to a price where people go, wow, this was only $250 an ounce back in the year 2000. Maybe I should be buying silver instead. That's what caused silver to explode in the 1980s. It's when gold got past a certain price and it seemed relatively expensive and silver was cheap. But the gold-silver ratio back then wasn't 100. It was like 50. And it went to 14. And so there was a tremendous outperformance by silver. And I've made the case,
According to Metals Daily Statistics, silver prices moved slightly, closing at $31.67 per troy ounce, a slight 0.18% down from Friday's close of $31.73. Silver is still one of the best performing assets of 2025, up nearly 12% so far, despite this slight decline. Silver's long-term potential is still being emphasized by renowned precious metals expert Mike Maloney, who predicts a potential spike to $300 per ounce, which would be roughly 10 times higher than current prices. According to Maloney, silver's relative scarcity and crucial involvement in quickly expanding industries like solar energy, electric vehicles, and advanced electronics might lead to a supply shortage, even while gold is still more generally held. He also emphasizes the gold-to-silver ratio, which has recently soared much above 80 to 1 after previously ranging between 15 to 1 and 30 to 1. He contends that a return to the historical average would cause silver to rise far faster than gold in the upcoming years. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you and enjoy the video.
I think that's a great idea. In fact, I think that people that have financial planners and advisors should start advising their advisors. Learn as much as you can about it. One of the things that I said in my previous video was that the best investment that you can make is in your own financial education. That's the most important thing. And so if you feel that you're starting to know more about it than your financial planner, financial advisor, either start educating them or fire them. Yes. But that's my own opinion. It's not financial advice. I don't give advice. I tell people what I do. But this chart, to me, shows that gold has a long way to run because nobody owns it yet. There's very few people that have any significant portion of their assets in gold. And when you look at where it was back in 1980 at the peak, it just sort of reiterates that the financial advisors will all start telling you to go for gold at the wrong time. This chart would have been like the 0 to 1%, meaning 0%, because nobody recommends 0.7%. Those columns would have been up close to 100% back in the year 2000 when gold was just $250 an ounce. In fact, all of your advisors would have been telling you to stay away from it, that it's dangerous. The financial planners, they're usually doing something where they're selling you a product that they make a commission on. And so just because of that, and it's slow for them to figure out products where they can make a commission. There will come a day where they'll all be able to make a commission on some gold product or another. And as we go into a blow-off top, and it becomes easy for them to sell this idea to their clients, and their clients are, yeah, put me in gold. Well, that's exactly the wrong time. If you want a confirmation on that, watch the comedy Brewster's Millions, and John Candy brings in this financial advisor and John says, oh yeah, he's got me in collectibles and stamps and even in gold. And this is like, it was released in 1982 or 83 after the bull market was over with. This is when the bear market had started, and it is typical for financial planners and mass media. And so there really was no reason to go with it. I let the gold-silver ratio determine what I buy. And at 100 to 1 right now, it might go higher. And there are people saying that it's going to be this way permanently. The second that gold goes to a price where people go, wow, this was only $250 an ounce back in the year 2000. Maybe I should be buying silver instead. That's what caused silver to explode in the 1980s. It's when gold got past a certain price and it seemed relatively expensive and silver was cheap. But the gold-silver ratio back then wasn't 100. It was like 50. and it went to 14. And so there was a tremendous outperformance by silver. And I've made the case, if you don't have my latest book, you should at least, it's only $9.99 for the Kindle version. And in there's a chapter on silver that explains if silver goes into the same type of bubble that it was in 1980 against the other asset classes in society, including the growth of the money supply, currency supply, the growth of the real estate, the stock market, bonds, I compare it against everything that I can think of. And it all points toward triple digits and in some cases quadruple digit silver, which I don't think is going to happen. But I do think a 10-bagger from here, $300 silver, that is entirely possible. But it takes monetary demand.
Mike Maloney describes a significant change in the historical significance of gold. In the past, gold served as genuine money and was the foundation of the American monetary system in addition to being a valuable metal. However, that is no longer true. Today, the global market, not governments, determines the price of gold, which is a freely traded commodity. When President Richard Nixon terminated the Bretton Woods Agreement in 1971, thereby severing the link between the US dollar and gold, this significant shift got underway. Since then, the price of gold has fluctuated according to supply and demand, rather than being maintained at a constant rate. Large price swings resulted from this, particularly during the 1970s economic crisis. Gold's price reached a record high in January 1980, as investors flocked to it as a safe haven when inflation and recession set in, a phenomenon known as stagflation. Today, the peak would be about $3,300 after accounting for inflation. But then, during a period of robust global economic expansion and little demand for alternative stores of value, gold went into a lengthy drop that lasted through the 1980s and 1990s. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
Okay, first of all, it wasn't a confiscation, it was a gold nationalization. They didn't take it from you, they bought it from you. But they bought it from you for $20.67, and then the following year, unpegged the dollar from gold and then repegged it. And over a 2-month period of doing that, the international exchange rates changed to where gold was $35 an ounce. At that point, it had made up for the fractional reserve scheme that the Federal Reserve was perpetrating on us. And it accounted for all the currency that had been created. And so they froze it at $35. There was no longer, there was a 100% coverage for the currency that was out there. Also, gold was the monetary base, and it was in circulation as U.S. currency. This time, it is being freely traded. The price is not determined by, it's no longer $35 an ounce as determined by the Bretton Woods system. It's freely traded. And then there's all these huge institutions that if it was nationalized once again, it means like GLD is one of the big, JP Morgan is one of the big custodians for GLD now. And so it means the U.S. government confiscating or nationalizing JP Morgan's, the GLD holdings and so on. I just don't think that they can do it this time. However, if a currency is dying, a country will probably do almost anything to protect that currency. So if we do go into some type of hyperinflation, at some point, you may want to try and front run something like this, but it's not going to happen unless there's this huge hyperinflation going on and gold is soaring to an infinite price against the dollar, and they've got to protect the dollar by nationalizing gold and controlling it once again, because gold is that canary in the coal mines. And if they do that, it's going to be at an astronomical price. And then you sell it and you get rid of your dollars and you buy something real right away. Real estate, high dividend yield stocks, just something else. Cameron, the guy that used to put up the news on goldsilver.com, Cameron Hamza, he would go, wow, I had to really go deep for that one, talking about deep into the internet, really digging to find stuff. And Tim Burris would find us the most obscure data sets and so on to be able to analyze and make these charts from. And it did contain a lot of new stuff. Another guy gave it a 1-star rating because there was no Kindle version. Well, the following week, the Kindle version came out. Another guy gave it a 1-star rating because he lived in New Zealand and the freight was high. Is that my fault? Those 1 stars are what keeps this book from being a 5-star. So, anyway.
Maloney emphasizes that gold served as the monetary underpinning in those days and was more than just a trading asset. It was directly linked to the value of the US dollar and was in circulation as money. In the present day, things are quite different. Without governmental price controls, gold is now freely traded on the open market, and investor emotion, supply, and demand all affect how much gold is worth. The dollar is no longer legally tied to gold, and the price is no longer set at $35, as it was under the previous Bretton Woods regime. He also brings up an intriguing point regarding the contemporary financial system. It would be much more difficult for the government to try nationalizing gold again now. Large financial firms like JP Morgan, which oversee substantial gold holdings through exchange-traded funds like GLD, would be immediately affected. In today's interconnected global markets, nationalizing that gold would require seizing control of institutionally managed, privately held assets, which would be challenging from a political and logistical standpoint. However, Maloney issues a caution. In the event of a US dollar collapse or a period of hyperinflation, governments have historically been known to take extreme measures to safeguard their currency. Reintroducing some kind of gold control may be one way to do that. He does, however, think that such a shift would only occur in dire situations, such as when inflation is out of control and there is complete distrust in the dollar, as gold is rapidly increasing in value and serving as a clear indicator that the currency is failing. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.